With most of its population under the age of 20, about 45% of those in Sub-Saharan Africa are unbanked to date. Based on a recent EFINA report, 36% of Nigeria's adult population does not use modern financial services. This places Nigeria as one of the 7 countries contributing to the huge population of unbanked people in Africa. Hello there, I am Adekunle Adebiyi. I'm a business executive skilled in handling revenue generating processes. I'm also skilled in increasing market share, applying revenue growth plans, and leading commercial strategies across corporate teams. In the year 2020, Nigeria, one of the largest economies in Africa, set a goal to reach 80% financial inclusion by the end of the same year. But by the end of that same year, only 64% of Nigerian adults were financially included. Why does this matter? You will get to find out shortly. Before we move on, bear in mind that financial inclusion is achieved when individuals and businesses have seamless access to a wide range of financial products and services at an affordable rate and in a sustainable manner. First, it is important to note that traditional banking and financial technology are not on either side of the divide. Instead, there is a convergence. They both exist to complement each other and not to replace one another. So, what does financial inclusion mean? Financial inclusion is simply the use of technology to ease financial processes and make them more accessible to all. With the obvious advantages of technology, traditional banks are evolving. They are collaborating with Fintech services to explore additional benefits within the ambits of their licenses and that of the Fintech companies as well. All thanks to Fintech solutions. Gone are the days of endless bank queues, tally numbers, frequent unsuccessful transactions, and unnecessary bank visits that today are done at one's convenience. Interestingly, 64 million unbanked people in Sub-Saharan Africa have access to mobile phones but are yet to explore banking services like microcredit, microinsurance, and other everyday banking services. But how does financial technology contribute to financial inclusion? Financial technology closes the gap between those who have access to financial services and those who don't. As mentioned earlier, there is a convergence between Fintech and traditional financial services. Fintech has made banking services accessible to people in rural areas through services like mobile money and point-of-sale centers. Where there are no banks or automatic teller machines, ATMs, point-of-sale spots are available to provide financial services to the unbanked. Without being tech-savvy or even being literate, people can easily and safely send or receive funds from customers, families, and friends for other businesses and personal needs without hassles. Another role Fintech plays in financial inclusion is the alternative it provides to lending. In the past, SMEs had to go through a rigorous loan application process before they could be given loans by traditional financial institutions. Even at that, the possibility of getting a loan remained slim for small business owners. But with Fintech, credit loans are easily accessible without collateral in some cases, and of course, with zero or low interest rates. Banks are fast adopting these Fintech solutions, and as Fintech helps in bridging the gap between the banked and the unbanked, the economy improves as more money gets circulated within the economy. This improves the lives of people as there are more opportunities for entrepreneurial enterprises to flourish. In summary, we must leverage the opportunities that Fintech has provided to close the gap that exists between the banked and the unbanked in Nigeria.